Stepped up basis. What in the world is that? Okay, so in order to understand stepped up basis, you have to first understand what cost basis is. According to the Internal Revenue Code, when you acquire property, when you purchase property, the amount that you pay for that property is the cost basis, okay? Now, when you sell that property, the difference between your cost basis and your sale price is going to be your profit or your income. And then any capital gains taxes that might be due are going to be factored off of that income. Now, I'm keeping it super simple. There are different things that you can use to add and increase your cost basis, such as renovations to the property, upgrades. We're not going to talk about all that, right? So let's do a quick hypo. Let's say you purchase property for $100,000 and then you sell it for $1 million. You now have $900,000 of profit or income that you're going to have to claim capital gains taxes on. Whew, that's a lot. Okay, so now let's get into what stepped up basis looks like and how it works. Stepped up basis is going to be the basis that your beneficiaries, when you pass away, are going to be able to use. They're going to step into your shoes and they actually will have a basis that is equal to the value of the property at death. So here's how this looks. You purchase the property for $100,000. You pass away 10 years later. The property is now worth $1 million when you pass away. Your beneficiary's basis in that property is actually going to be $1 million. It is not going to be the $100,000 that you paid for that property 10 years ago. Here's the thing. I mentioned in an earlier video that when you transfer property to your child by a deed right now, they're going to be losing tax benefits. This is the tax benefit they're going to be losing. If you transfer that property to the child now, there will not be a stepped up basis. You only get a stepped up basis if the property transfers at death.